Every business transaction tells a story. But if a business has thousands of transactions a day, how do they keep that story from turning into a chaotic mess? They use a master map. In the world of accounting, this map is known as the chart of accounts, or the COA. Think of the chart of accounts as the filing cabinet for every single penny that enters or leaves a company. It is a complete list of every category or account where money can be recorded. From the coffee in the break room to the million-dollar factory equipment, the chart of accounts ensures there is a specific home for everything. Without a chart of accounts, a business is flying blind. You wouldn't just say, "I spent money." You need to know, was it an investment, a bill, a refund? The chart of accounts provides 4 critical functions. Consistency, it ensures that every bookkeeper records rent in the same place every month. Reporting, it allows the software to pull data instantly for those financial statements we discussed earlier. Analysis, it helps owners see exactly where they are overspending. And compliance, it makes tax season a breeze because your categories already match what the government needs to see. In a professional chart of accounts, we don't just use names, we use numbers. This coding system allows for quick data entry and keeps the accounts organized by their type. Most businesses follow a standard 5-category numbering block. 1000 to 1999, assets. These are things the business owns. 1010 might be your checking account, while 1500 might be your office building. 2000 to 2999, liabilities. These are things you owe. 2010 is usually accounts payable, the bills you haven't paid yet. 3000 to 3999, equity. This represents the owner's stake. 3010 might be retained earnings. 4000 to 4999, revenue. Every dollar earned from sales or services lives here. 5,000 and above, expenses. This is often the longest list, covering everything from payroll, 5,100, to utilities, 5,400, and travel, 5,800. The 5 major categories under chart of accounts are assets, liabilities, owner's equity, revenue, and expenses. 1. Assets, the owns. Assets are further divided into current assets, things that will be cash within a year, like the money in your register, and fixed assets, long-term items like vehicles or land. 2. Liabilities, the owes. Liabilities can be short-term, credit card bills, or long-term, a 10-year bank loan. The COA separates these so you know how much cash you need right now versus in the future. 3. Equity, the owner's worth. Equity tracks the money the owners put into the business and the profits that stay in the company. If you sell the business, this is essentially the value remaining after all debts are paid. 4. Revenue, the inflow. A smart COA breaks revenue down by source. If you run a pet shop, you don't just have sales. You might have 41-0 for pet food sales, 40-20 for grooming services, and 40-30 for training classes. This tells you which part of your business is actually making money. 5. Expenses, the outflow. This is where the COA gets granular. To manage a budget, you need to separate operating expenses, the costs of running the business daily, from non-operating expenses, like interest paid on a loan. Sometimes, a main category isn't enough. That's where sub-accounts come in. Instead of just insurance, a chart of accounts might have subcategories for workers' comp, health insurance, and general liability. This level of detail is what allows a CEO to look at a report and say, "Our electricity bill is 20% higher than last month. Why?" Here is the chart of accounts in action. You buy a box of printer paper. The bookkeeper looks at the chart of accounts. They see that 5,200 is the category for office supplies. They enter the transaction into the software using that code. At the end of the month, the software looks at all 5,200 series codes to build the income statement. Without that code, the computer wouldn't know if that paper was an expense to be deducted from profit or an asset to be kept on the books. There is no one-size-fits-all chart of accounts. A freelancer might only need 10 accounts. A construction company needs accounts for raw materials and subcontractor fees. A software company needs accounts for server costs. The goal is to find the Goldilocks zone. Enough detail to make good decisions, but not so much that the bookkeeper spends 10 hours a day trying to decide which category a $2 purchase belongs to. Today, modern software uses AI to suggest the correct chart of accounts account for you. If you buy gas at Shell, the software recognizes the vendor and automatically suggests account 5500, travel and fuel. However, the human accountant still needs to understand the chart of accounts to ensure the AI isn't miscategorizing a travel expense as a vehicle repair. The chart of accounts is more than just a list of numbers. It is the dictionary of your business. It defines how you talk about your success, how you measure your failures, and how you plan for the future. When you understand your chart of accounts, you understand the very DNA of your finances. Every penny has a place, and with a solid chart of accounts, you'll always know exactly where those places are.